one of the things that caused us to make that initial determination in late October and early November was the bounce that we saw in productivity, because we understood at the time that, hey, it's going to force people into the soft landing camp. See, at 228% of GDP, Chinese private non-financial sector debt is as high as it is in the world across all of these major economies. And more importantly, the Chinese private sector, or sorry, debt service ratio at 21% is much higher than all the major economies as well. At its core, what this model is trying to do is trying to figure out, the model is trying to figure out what everyone else is trying to price in. You know, it's using their own momentum against them, they being the folks on the other side of your trades. It's trying to figure out at the margins, what are these people trying to do across asset markets? And these are 42 of the most important markets in the world. We're talking things like the MOVE Index, the CVIX, the currency volatility.
To kind of track what you've been saying and what your work is, and it is remarkably accurate. It is very helpful to get the sense of all these variables and when they're changing. And so because I have been impressed with that, I'd love for our readers to hear about how did you develop this model and how does it work? You started your company not quite 2 years ago?
A little bit over 2 years ago, almost 3 years in April. Yep.
Oh, okay, great. And yeah, just love to hear the process and how you came up and how you wound up finding out that these variables would work and how often they change weightings and things like that. And let me just say, for the Darius followers out there who have joined us, we are Markets Policy Partners. We write a newsletter about market events, really all financial markets and government policy. And our readership is both policymakers in Washington as well as professional investors on Wall Street. And so with that, Darius, tell us how you built this model.
Well, look, Robert, it's a pleasure to be here. Thanks for joining. Thanks everyone for joining. You guys do great work over at MPP, and I just want to say thank you for having me. So, let's just, before we even get into the specifics of the model, let me give you a quick background of how we think about market risk, because you paid us a really nice compliment, which we appreciate, in terms of being generally accurate. And I think, part of the reason that's the case is not because, we have some special foresight into the future more so than the average investor. What I think we do differently that's really helped us and helped our clients at 42 Macro stay on the right side of market risk is we're a lot more Bayesian in how we interpret economic data, economic statistics, and ultimately market developments. We built a slew of models that quantitative systems really that allow us to constantly be absorbing data in the right manner that allows us to spot critical inflections in real time so that we can reposition our portfolios accordingly. On average, and this is obviously you can average analysis, averages tend to lead to average analysis, all those things, but on average, there's about 3 times a year where you should be materially making significant changes to your portfolio if you're going to stay on the right side of market risk and generally try to compound returns over time. Obviously, you can choose to ignore everything and just buy and hold and wake up in 30 years, but the reality is most of us investors aren't capable of doing that. So that's why we exist. That's why MPP exists. That's why 42 Macro exists, is to make sure that the decisions we are making are good decisions. So let me share my screen here. And so I'll just give you a brief overview into a couple of the models that we use to nowcast the market regime, and then we'll talk about the weather model, which I think is the main event here today, which helps us understand how to project that current regime into the future, if at all. So this is our global macro risk matrix. It's not a pretty chart for TV, but it's a very important chart in terms of helping investors understand what the hell is going on across global markets. And so how this model works is we are scoring 42 different markets from the perspective of our volatility adjusted momentum signal. And we're scoring, not only are we scoring those markets from the perspective of the momentum signal, we are also tallying how the current momentum signal is behaving relative to how the market is performed. And then we're summarizing that in a couple of slides. So let me just give you a quick overview of how this works. So you can kind of see it's organized by equities, volatility instruments, commodity instruments, currencies, and then rates, spreads, and yields, et cetera. And so, for example, let's take the S&P 500, for example. The S&P is currently bullish from the perspective of its volatility adjusted momentum signal. That's what the green check mark indicates. The red X indicates the bearish, and then the exclamation point indicates it's neutral. It's historically been bullish in Goldilocks and reflation, so both of those regimes are getting a point from that current bullish VAMS signal in the S&P 500. We're doing that same process across each of these 42 markets on a daily basis in order to sort of nowcast exactly what the hell markets are thinking the economy's in, or what our market's trying to price in. And so we summarize that here on this slide, where we see 27 of those 42 markets right now are confirming of Goldilocks. 15 are confirming of reflation, 5 are confirming of inflation, and 16 are confirming of deflation. The risk on regimes are obviously the green ones, and the inflation and deflation are the risk off regimes. And so right now, 43% of the total number of confirming markets is being allocated to Goldilocks. So we indicate Goldilocks as the top-down market regime. And generally speaking, as an investor, you want to be doing things that are in accordance with the top-down market regime. Most of it, there's no real way to know how long a top-down market regime is supposed to last in real time on an ex-ante basis. So, generally speaking, particularly when you're early in a phase transition, i.e. to a new regime, you generally want to be orienting your risk around that. And so what does that mean from the perspective of Goldilocks? Well, Goldilocks, you think about the key portfolio considerations in that particular regime. You're talking about risk assets tend to outperform defensive assets. High beta tends to outperform low beta as a factor. Growth tends to outperform value as a factor. Mega cap growth tends to outperform dividend compounders as a factor. U.S. stocks tend to outperform international stocks. Developed market stocks tend to outperform EM stocks. Spread products typically outperform treasuries in the fixed income market. Short rates typically outperform the belly, which typically outperform long rates. And then high yield typically outperforms investment grade. So that's sort of how we think about market risk
That
currently.
was definitely my experience in the equity markets when I was there forever.
Yeah, exactly. And again, the grid process, grid stands for Goldilocks, reflation, inflation, and deflation. They're named appropriately, right? I don't have to give you a litany of back tests to tell you that Goldilocks is generally going to be pro risk, and obviously should be taking more risk in that type of regime. What I think is the main event here for today's discussion, however, is the macro weather model, because it's not only enough as an investor to know what regime you're currently in, but obviously, in order to put on profitable trades, you need to have some sense of how long the current regime is going to last, and if it's about to change, what is it going to change into, right? That's kind of that's what we're all trying to do as investors. Most investors don't have specific nomenclature, or much less powerful tools that they're using to get to those answers. But in reality, that's what everyone's trying to do to some degree. And so we've just created a more systematic process around trying to kind of split that atom open here. So this right here, this what we're showing on this page is what we call our macro weather model. This model is designed to nowcast momentum across the various what we consider to be the principal components of macro, and it's relating that momentum back into a rolling 3-month outlook for the main asset classes. And so as you can see right down here in the middle of the page, stock market signal is currently neutral. The bond market signal is currently bullish. Dollar signal is neutral. Commodity signals bearish, and the Bitcoin signal is neutral. Before we unpack further, I just want to say that when you see a neutral signal on this page, what that signal is communicating to investors is that it's just a normal time to be taking risks in this particular asset class. You should be expecting on a rolling 3-month forward basis normal type of returns, normal levels of volatility. For the bond market, however, you should be expecting above median returns, below median volatility for this particular asset class beyond a certain threshold. And then conversely, the commodities, you should be expecting well below median returns and much above median volatility. And generally speaking, that's kind of what we've seen really since the advent of these signals a couple of weeks ago. So I'll go down I'll pause for a second to give you opportunity to ask questions, and then I can just kind of go down and further unpack how the model works.
Well, you have a confidence level also line in the last chart. How does that get determined? Is that
this right here, the strength of signal?
Yeah, exactly.
Yeah, so the strength of signal in this global macro risk matrix model, which again nowcasts the top-down market regime, that's just the percentile reading of the total amount of signal in the table. So at any given time, so what we're looking for, obviously, this is sort of a breadth process, if you will. We're using our volatility adjusted momentum signal in the context of how these different exposures have traded historically in those particular regimes to effectively create market breadth, not only figure out what the markets are pricing in, but how much breadth is associated with pricing those things in. And so we'd say we're in a 77th percentile of breadth for pricing in what markets are trying to price in now, which by and large is Goldilocks. And so obviously when you get to elevated readings of breadth, like 90th plus percentile, top decile type readings, we are typically on high alert for a phase transition in the short to medium term. And so that's
Interesting. Oh, so that often will signal the transition.
yeah, it's a leading indicator of a transition. it's a leading
How
indicator.
often are these in kind of order, Goldilocks, reflation, inflation, deflation, in bearish to bullish? Is that like a spectrum, or are these just separate categories and it bounces from one to the other all randomly?
Yeah, they're all separate categories. So Goldilocks is typically the most bullish, followed by reflation. Inflation is the most bearish, followed by deflation. Deflation is a mixed bag. Some exposures, more cyclical exposures, tend to have negative absolute returns in deflation, whereas some growthier exposures, U.S. Kind of mega cap quality type exposures, do tend to do quite well in deflation. So it's a mixed bag for deflation, but generally speaking, max bullish in Goldilocks, max bearish in inflation. Reflation is a little bit some deflation or somewhere in between. And in terms of what this taking a step back, at its core, what this model is trying to do is trying to figure out the model is trying to figure out what everyone else is trying to price in. It's using their own momentum against them, they being the folks on the other side of your trades. It's trying to figure out at the margins, what are these people trying to do across asset markets? And these are 42 of the most important markets in the world. We're talking things like the MOVE Index, the CVIX, the currency volatility. We got things like credit spreads in there, short rates, long rates, credits or yield curves, et cetera. So there's a lot of information in this table in terms of, okay, what is the market pricing in? Let me orient my portfolio into that. And if I'm going to start to rotate my portfolio or build in trade asymmetric trades, bets, I need to understand what is the market likely to price in next. And that's where we bring in things like our weather model and of course our fundamental research process.
One of the things that just jumps off the page on that last page is all the credit scores. There are
Yeah.
big red X's everywhere.
Yeah. So
Can you
it's been a
explain?
great time to be a credit investor in the fixed income markets.
Is
Absolutely.
that very common where you get a whole, one whole category that's just nothing but X's?
Yes and no. Certainly, we've had a pretty significant phase transition dating back to in November of last year. In terms of the phase transition we've seen in the global fixed income markets, and as a function of that, you're seeing a lot of new signal develop. That's why they're all red X's, because it's a breakdown from the previous bullish regime in terms of interest rates, the previous bullish regime in terms of spreads, et cetera. And so that's kind of what's happening there.
Only because credit has so often been a coincident and damaging factor in overall economic activity. And since the great financial crisis, we haven't had to worry too much about credit because the banks are so chock full of
100%.
equity capital. What is interesting is the amount of private capital that has been raised on the side that is competing with banks. Are you capturing that in these tables?
Not so
Private
the,
market?
the nominal stock of private capital, no, but we certainly do fundamental research to understand exactly what's happening from the perspective of corporate balance sheets, household balance sheets, et cetera. And what we continue to see is that they have raised a lot of debt, but it's been more of a mix shift. So if you look at corporate debt divided by total assets, for instance, it's been pretty much flat for pretty much the last kind of two business cycles. What's changed the most in the last business cycle is a lot of cash that we're seeing on corporate balance sheets. That's up at about 5% of total assets, highest ratio we've seen since the early 50s. And so we've seen some favorable dynamics in the context of the private sector balance sheet that has supported a lot. That's been supported at the margins by and is supporting reflexively the kind of private credit functions that we're seeing out there. And so, one of the things that we talked about, we don't have to get into this in this particular discussion, but one of the things we outlined in the summer of 2022, Robert, is our resilient U.S. economy theme. And part and parcel to that theme was understanding that U.S. private sector balance sheet dynamics had sort of moved in a way that suggested that a lot of the kind of, I don't know, hullabaloo, if you will, around the policy rate is mostly noise, because it's not really flowing through to the private sector in deleterious ways that it ultimately would a lot of investors kind of were wrong-footed on. And so that's, in my opinion, I think that theme is still ongoing, and why I think that the probability of a soft landing is higher than the probability of a hard landing or a no landing.
And this is a similar look on the consumer as well, right? The consumer's balance sheet has was filled up in 2021, 22. And even though you have rising credit card debt right now, overall danger signs are still pretty muted.
Very muted, very muted. So if you two things I would flag on that particular comment. If you look at a household debt divided by nominal disposable personal income, it's at 97% or 97 cents on the dollar. That's cyclically depressed relative to prior cycles. Now, obviously, the couple cycles ago was a bubble, so we're not necessarily have to get back to that level, but it's telling us that there is room to extend credit for the household sector. But I would argue more important, what is more important typically than the level of debt on a ratio basis is the debt service ratio itself. And the debt service ratio accounts for all the flow through from monetary policy and changes in income, et cetera, as you progress throughout the business cycle. And at 9.8%, we're effectively at an all-time low. Obviously, it was lower during COVID when we are just stuffing the channel with free money, but but it's effectively at an all-time low. So you're right. Your assumption that we've sort of de-risked from the perspective of private sector balance sheets is actually very correct. And one of the reasons why the economy has just consistently and persistently surprised to the upside. Now, it's not the only reason, but it's certainly one of the key reasons.
Well, it is interesting that if you're a general consumer of news, boy, they throw a lot of headlines at you to try and scare you. And one of the headlines that was trying to scare everybody because the data looked pretty scary was the commercial real estate market last year. And then they kind of disappeared from the headlines as interest rates came down. Where do you see that as part of the credit? Because the problem there is just the refinancing and the higher rates. And then the office sector, of course, you have a structural problem on occupancy. But what's your work showing on commercial real estate?
Yeah, I don't have anything in this particular deck. But in terms of the conclusions of that work, the work was this is not a big deal. If you look at the exposure, the exposure is pretty de minimis. We're talking about $1 trillion of total exposure. Obviously, not all of it needs to be refinanced, and certainly not all of it needs to be refinanced tomorrow. But secondarily, the exposure is concentrated on the balance sheets of banks that are very much not systemically important. So if this is going to be an issue, it's going to be an issue for the borrowers and the banks, the particular borrowers and the particular banks, rather than a broader macro issue for the economy. That's been our conclusion. We're going to stick with that until we start
It
to see
becomes more of a policy issue in Washington that doesn't really have a lot to do with what the economy is going to be doing.
100%. Well, it may become because and conversely, perversely, things that become policy issues in Washington tend to wind up with policy solutions out of Washington. Something like the bank term funding program was born out of regional banks blowing up,
I
and we
was
got rich from it.
I was heading in that direction,
Yeah.
and what happens when you get little skirmishes, wildfires that you have to put out? It's a green signal for the markets. It's more liquidity coming into the system. It's losses that are being deferred.
Mhm.
And so ironically, if we wind up with a problem when the BTFP step gets turned off in March, if they turn it off, if once that liquidity comes out of the system, if it causes something else, you'll see another program come along, and that's kind of one of the marks of our society over the last, I don't know, 20 years.
100%, my friend. We can get into a deep dive on some of these longer term structural political dynamics, but I'll reserve that probably for our next time. So
Yeah,
let's
but
get, yeah, let's get back into
yeah,
the weather model because I think it's a very important tool to help investors understand
right.
why our clients are generally on the right side of market risk. We're not always on the right side of market risk. There are phase transitions, and you got to risk manage those appropriately. But we tend to stay on the right side of market risk because we are implementing this differentiated process on a daily basis, 6 days a week here at 42 Macro. So I'll start with the real economy cycle. As a matter of fact, I'll give you an opportunity to see how this process actually works. So I'll start with the real economy cycles here on the left. Those are organized by growth, inflation, employment, profits, and fiscal policy. Growth is currently trending higher, is expected to inflect and trend lower over the next 12 months, according to consensus estimates. Headline CPI is trending lower, is expected to continue trending lower over the next 12 months, according to consensus estimates. The unemployment rate is currently trending higher. It's expected to continue trending higher over the next 12 months, according to consensus estimates. If you look at the implied sales growth rate for the equity market, that number is trending lower. The implied earnings growth rate for the equity market is trending higher. If you look at the sovereign fiscal balance divided by nominal GDP, that ratio is trending higher now and recently inflected to a positive trend. The dollar real effective exchange rate is trending higher. And so, that's sort of the summary of all what we think are the main indicators to track for the real economy cycles. On the right side of the chart, we have the financial economy cycles sort of derived across liquidity, credit, interest rates, and then we identify fear and greed through the lens of aggregated dollar and treasury positioning and aggregated commodity and equity positioning. So let's go down the list here. 42 macro net liquidity is trending higher. Our net liquidity model, for those who may be new to us, that's the Fed balance sheet minus the Treasury general account balance minus the reverse repo facility balance. Morgan Stanley made that popular across global Wall Street, but you heard it here first. Global liquidity proxy, that's the global central bank balance sheet plus global broad money supply plus global FX reserves minus gold. That's our second liquidity model. That's in fact a more powerful signal. That number continues to trend higher as well, and the leading indicators for those particular for these two models suggest that we should see at least another quarter or two of positive uptrend in these liquidity metrics. Domestic broad money supply is trending lower. Global PPP weighted broad money supply is trending lower as well. So domestic and global credit growth is trending lower. The benchmark policy rate is trending higher. If you look at what's priced in the 2-year relative to that benchmark policy rate, that's trending lower. Aggregated dollar positioning. So this is all the major currencies plus gold across versus the dollar in terms of the CFTC non-commercial net length divided by total open interest for all those currencies and then gold. That minus net 16%. So the dollar is net short. Investors are net short the dollar by minus 16% across those instruments. That's a neutral signal currently. Investors are net short the treasury market across the curve. That's an extreme bearish signal. Investors are net short the commodities markets, all the 19 components of the CRB index to the tune of minus 1%. That's an extreme bearish signal. And then investors are net short all the equity market instruments that the CFTCOT keeps track of to the tune of minus 3%. That is a neutral signal. And so each of these signals, Robert, contributes independently to each asset class in the middle of the page. And so what do I mean by contributes independently? Well, let's look at a specific example to understand how the tool actually functions. So we'll unpack the growth component. These are the two component features that we use to identify, where growth is, where the current growth is, and where it's likely headed over the next 12 months. And so right now we're currently in a positive regime or an accelerating regime for the OECD composite leading indicator. And that historically has produced positive excess returns for risk assets. And so what you see here in terms of these back tests in the second half of the chart, these are excess return back tests relative to this rolling 3-month forward baseline of returns in these particular asset classes. So you're typically getting positive excess returns for stocks, commodities, and Bitcoin when growth is accelerating, and you're getting negative excess returns relative to that baseline for the bond market and for the US dollar when growth is accelerating. Conversely, when you look at the right side of the page, we're a decelerating regime for the real GDP growth delta. And so we're currently sort of adding this particular back test to those composite signals in the middle of this previous page. And so right now, when you see a negative delta for real GDP growth, you typically are contributing negative excess returns to the stock market, the bond market, commodity market, and crypto market, and positive excess return to the dollar. So this process we are doing, we're now casting each of these features 6 days a week, and we're reporting back into the composite signals each of the corresponding excess return dispersion back tests that correspond to the current signal. And so when you think about doing this on a daily basis across each of these component features, each of these principal components of macro, you have a lot of information that investors are sort of out there trying to chase with some Bayesian, some procedural, some ad hoc investment process, but everything we're trying to look at as investors and form thoughtful opinions on is actually being nowcasted into this table on a daily basis.
Yeah, it's a different model than all the strategists I've worked with on Wall Street, who are very good at generally assessing what's going on and generally talking about it.
Yeah. Trust me, I used to sit in that seat, my friend, and look, it's we have a hard job, right? Like it's hard enough investing well, but then investing well in public and hopefully having to be wrong in public. I certainly tip my cap to anyone who's willing to do that for a living. But at the end of the day, to me, it's not about being right or wrong in financial markets. My job here is to help 42 micro clients make and save money across market cycles. That's it. Period. Point blank. Stop. And so all the tools that we've introduced, including our weather model and our global macro risk matrix, which is a previous tool, those tools generally help us do that better than we otherwise would, relying on just my intellect, relying on just fundamental research alone.
In how many variables did you try and throw out because they didn't work?
Ooh, oh man, you want to get into
Hundreds, right?
sausage making hundreds. Yeah, no, it took me about 3 months of just trial and error, back testing different features to actually wind up with the 20 features that are represented here on the page.
Of that.
Yeah,
And
no, it's, I
and
mean,
then how do these different measures get weighted differently? For instance, liquidity. Casual investors will look at what the Fed is saying and doing and what people are expecting the Fed, and they'll say that's 90% of the explanation of the S&P,
uh-huh.
and it's probably 80% of bonds.
Yeah.
Um, but for the Fed, for example, they control interest rates, but they also control liquidity. And at various times, rates are more important than liquidity, and at other times, liquidity is more important than rates. How
Mhm.
often do the weightings of each of these categories change?
In theory, daily, not by much daily, but this is a live rolling back test. So let's use liquidity as an example here. So we have our 42 macro net liquidity model and our global liquidity proxy. So just as an aside, I don't believe in weighting models. And the reason I don't believe in weighting models is because the principal components, the order of the principal components will change over time. If you do PCA analysis on any discrete period of time and then start to compare that across on a cross sample basis, you're going to notice that, hey, all the same principal components are the same, but in this particular period, inflation mattered more. In this particular period, growth mattered more. And so, you need to rely on a significant amount of hubris as an investor or as a model builder to say that growth should always be weighted X, or inflation should always be weighted Y, or liquidity should always be weighted Z. How we get around,
Or
yeah, go
or
ahead.
throwing in the subjective judgment that today inflation is going to be 8% instead of 6% yesterday,
100%.
right? You
That's
don't
another
want to put
problem in
it,
and of itself.
you,
100%.
yeah, you want to eliminate the subjectivity. And it also sounds like these self-adjust over time because when they get extreme, the indicator will naturally be a little bit higher. Is that right?
Exactly, exactly. So this model is perpetually training. It's always training itself. So it's a very rudimentary form of AI. I don't believe in the sexiest forms of AI yet because I don't think anybody understands what the hell is actually going on, and this is why you don't see everyone waking up and hitting a button on their stock portfolio. Whatever the AI told me today, I'm going to take my life savings and do that. No, you don't see a lot of people lining up to do that yet for obvious and good reason.
No,
Um,
not yet. But maybe that'll add to the productivity boost that we'll talk about later.
we all just hit a button to do our jobs and go back to watching TV or something, watching Bills kickers miss field goals.
We're watching AI create entertainment for us.
Exactly. Yeah, exactly. So yeah, that's quite the we're all looking forward to that circular reference. But just putting a Tiffany bow on your question here. So just give me a sense of how the model works again. What we're trying to do is identify uh, conditions in these, in the momentum conditions in each of these indicators that actually produce excess returns. So it's one thing to have a indicator that's, fancy and everyone cares about it, but if it does not produce any excess returns, positive or negative, going from state to state, condition to condition, then it's a useless indicator. There's no real reason you should be tracking it as a particular indicator. It's a better way to say that is it's actually not an indicator. And so right now, let's use the stock market for instance. When the 42 macro net liquidity is rising or it's trending higher, it's a positive excess return for the stock market to the tune of plus 1.1%, of course, the lifetime of this backtest. 20 years from now, that could be plus 2%, or it could be, plus 0.5%. Currently, it has a higher weight than the plus 80 basis point backtest that our global liquidity proxy has for the stock market. And so over time, that plus 0.8 could rise to 1.8 or fall to 0.5. And so that's how the weights are determined. It's about how much excess returns dispersion do you produce for this particular asset class. And so that's, in my opinion, that's why I think the model is, again, it's not perfect. We don't purport to build perfect models or have perfect solutions here for our clients at 42 Macro, but we have very good solutions and very good models. And I think the reason this model has been so powerful and again, helping our clients stay on the right side of market risk is because it is smart. It is learning. It's learning from its own mistakes and revising those excess return dispersion back tests appropriately as we move forward through time.
Excellent. You're a good teacher.
Thank you, man, my friend. Well, I get paid to do this, so I should be pretty good at it. So you mentioned something about inflation that I think it's important to unpack. Trying to say, is inflation going to be 8% or 6%? And don't get me wrong, I started my career, as kind of as a more traditional kind of economist before I kind of graduated up to the strategist role. And, I've built the variety of models that are designed to produce forecasts for GDP, forecasts for inflation, those types of variables. And the reality is most of those models, whether they be DSG or autoregressive, they broke in 2020. And there's no way, there's no getting around the fact that they broke in 2020 because we had a jump condition in a significant number of critical economic variables that, quite frankly, you couldn't train a model on. If you did train a model on, that just means you would have to admit that your model didn't work for the previous 40 years. And so we are in a new paradigm, and we're all scrambling as economists to figure out, okay, what models actually work in this new paradigm, in this new kind of higher nominal GDP environment, higher volatility environment in terms of growth and inflation, and ultimately, if those models work, what are the appropriate sample sizes and appropriate back testing periods, look back periods to train the model on? Those are very much open questions still to this day, here in almost 4 years later. Really almost 4 years later in terms of this post-COVID dynamic and all the fiscal and monetary stimulus that we're still working our way through. But we've built other models that are a little bit more nonlinear that have helped us, sort of account for some of these dynamics as a function of those old models breaking. And this is one of those models. This is our secular inflation model. What this model is designed to do is interpolate the normalized change of these key indicators upon the underlying trend of inflation. And so what that's designed, so that's effectively trying to say, hey, we had a jump condition in these particular indicators. We should have a similar, on a normalized basis, size jump condition in the underlying time series. And that's what this model is designed to do. So what it's saying is that the key summary here, or the key conclusion, is that the underlying trend of core PCE was 1.6% in the 2010 to 2019 decade. Based on the delta adjusted z-scores here, the normalized change or the jump conditions that are observed in these critical variables that our research and other research has shown to be highly correlated or highly co-integrated with that underlying trend of core PCE over time in different intervals. Our model saying, hey, we've probably jumped condition to an underlying trend of 2.6% to 3%. Now, that doesn't sound like a lot. And if you're a crypto kid and you're only concerned about hundreds of thousands of percent returns, that doesn't mean anything. But you, Robert, me, Darius Dale, understands that the Fed might not be comfortable with 2.6% to 3% core PC inflation without some sort of a tacit or explicit policy change. And so, this is something that has really guided us throughout this kind of decade, or at least the last couple of years, in understanding that, hey, inflation is probably not as transitory as a lot of policymakers think. So that we were golf clap for getting that call right back in early 2022 and understanding that, hey, the Fed's probably going to have to tighten a lot more than investors understood at that time. Obviously, it's all review mirror now. But and so the second thing I would say on this is that if this model is correct, we're probably going to go to 2% inflation, maybe even hang out there for a little bit. But that's probably the new cyclical low for the time series, as opposed to the underlying mean of the time series, which is what the Fed is trying to guide to. And at some point in the future, there's going to have to be a reconciliation process that obviously involves more volatility in the fixed income markets.
Fascinating. Yeah, we come to a very similar conclusion that we've got, and the Fed is going to be uncomfortable with where the inflation rate resides. As soon as the volatility comes out, we get a stable read, it's going to be uncomfortably high. So they're going to be for the economy, it'll be uncomfortably tight relative to an uncomfortably accommodative stance over the last decade.
Robert, I love that statement, my friend, because we're already starting to pick that up in our data. And so, as I mentioned, if you think about our process as sort of like a triangle, there's the start, the point, the tip of the spear, that triangle is what the hell are markets trying to price in? That's the top-down market regime process that we use our global macro risk matrix to identify. The second step of that process is refreshing the weather model and incorporating signal from the principal components of macro back upon the markets to say, hey, is the current regime, does it have a high probability of sustaining itself over the next few months? If it does not have a high probability of sustaining itself according to those composite signals for the asset classes, then we need to lean on our fundamental research process, which is the third point of the triangle, to say, okay, if it's not going to be in Goldilocks for an extended period of time, where is it going next? And we use, again, this is our fundamental research. So in this chart here, we're showing median CPI, trend mean CPI, the median PCE deflator, the trend mean PCE deflator, and then the core PCE and super core PCE. And the blue bars in each of these panels represent the 3-month annualized rates of change. The red line in each panel represents the year-over-year rate of change, and the light blue line in the panel, each panel represents the 2015 to 2019 trend of the 3-month annualized bars. And so what I'm showing in the top panel, you should be very concerned as an investor, is that we've already bottomed in median CPI on a 3-month annualized basis and have since reaccelerated to 4.6%, which is almost double the pre-COVID trend. We bottomed in trim mean CPI, pretty much right at the pre-COVID trend, and have since accelerated at a couple, maybe 100 basis points or so to 3.4%. We're seeing similar dynamics in supercore CPI. So supercore CPI down here, we bottomed in, I want to say in June here, and we've since accelerated to 4.3%, which is more than double the pre-COVID trend. So there are signs, emergent signs of what we could call sticky inflation here in the U.S. economy. Now, whether those emergent signs is just a sort of transitory blip, or is it going to turn out to be, well, we actually bottomed a while ago. The red lines, which is what everyone else is focused on, the year-over-year rates of change, are going to bottom at levels that are inconsistent with not only the Fed's 2% mandate, but also inconsistent with where the Fed has core PCE projected to be year-end 2024, year-end 2025, and ultimately where rates have to be. So there is a potential reconciliation process ahead of us as market participants, if and when the inflation data starts to signal that it's doing something materially different. But when we look at a broader set of leading indicators on inflation, whether it be the prices, component prices, PMIs, in the ISM surveys. We look at to the prices indicators in the UMich and the Conference Board surveys. We look at the prices components in the NFIB survey. The New York Fed has a pricing survey. There's a lot of leading indicators that suggest the momentum in inflation is still headed to the downside, at least over the next quarter or so. But then we obviously have to, again, refresh this Bayesian research and risk management process 6 days a week so that we can spot when those leading indicators are starting to say something different, so we can signal that to our clients and say, hey, Goldilocks is about to end. We're probably headed for inflation. Inflation's risk off. Do something different.
It's so interesting to see that during this period of time of reaccelerating inflation, that the bond market was actually rallying like crazy.
Yeah, 100%.
And
Well,
the 10-year was rallying like crazy.
well, don't forget. Don't forget that's the leading edge of inflation. The inflation that everyone cares about, and particularly the Fed, core PCE is doing exactly what the bond market wants it to do, which is exhibited textbook deceleration. We're back down at 2.1% 3-month annualized for core PCE. We're at 1.9% 6-month annualized for core PCE. And that to me tells me that the 3.2% year-over-year rate is headed lower in the coming months. And so that's what the bond market's anchored on. But those median CPI statistics, those trim mean CPI statistics, that's kind of show breadth in the same way that our global macro risk matrix is trying to show breadth for the markets. Those breadth type indicators are saying, hey, wait up. We're getting obviously some very positive things that have higher weights are driving down the main core PCE and even super core PCE. But if you look at it from a breadth perspective, the inflation genie is definitely not back in the bottle. And ultimately, in our opinion,
and this is what makes markets so much fun, when you uncover, indicators that are telling you what's much more likely to happen in the next 3 months than the market is reacting the last 3 months about.
100%. And again, this is why we start every morning here, 6 days a week at 42 Macro, with refreshing the global macro risk matrix. Okay, what are markets trying to price in? Refresh the macro weather model. Okay, is what markets trying to price in have a high probability of sustaining itself over the next 3 months? And then if it does not have a high probability of sustaining itself, I mean, if or not, we're going to do the research anyway, but if it does not have a high probability of sustaining itself, then we need to really lean on our fundamental research to try to help investors pivot or position or prepare to position for the eventual transition. And so in my opinion, I think if we're going to exit this Goldilocks regime, it's going to be to inflation and not to deflation, because we think the probability of a hard landing is a much lower probability than that of a no landing.
One of the headlines last year that it wasn't so much a headline as it was an opinion about a minority of economists, that with a structurally higher inflation rate, we had, and a structurally gigantic budget deficit, that we were going to run into a problem of supply demand on the Treasury front that would keep long-term treasuries elevated, rates, yields elevated for a long period of time. And that just about peaked right as the bond market was about to have one of the biggest rallies of our lifetimes.
Yeah.
At what point does that become an issue? What is driving this? Is this just that the United States economy is so strong that it's pulling capital in from everywhere?
I wouldn't go that far. I think what's driving the move in the bond market is the fact that we're having some very positive outcomes on inflation. I mean,
Yeah.
so we just showed you the textbook disinflation we're seeing in core PCE, the textbook disinflation we're observing in super core PCE. That should, we're headed to at least 2.5% on year-over-year super core PCE in the next quarter or two if these numbers continue to hang out where they are or even bounce lower. And so that's in my opinion, that's what the bond market is anchoring on, because ultimately what it means is what Jay Powell confirmed in December, which is if inflation continues to do what we think it's going to do, we have to cut rates from a technical perspective in order to avoid implementing incrementally tighter monetary policy. Now, there is obviously an open debate on how tight monetary policy actually is. We started from the perspective in summer of 2022 that it's not going to be very tight because it's basically a sideshow now. Obviously, it's going to really impact borrowers at the margins, but there's so many positive things going on from the perspective of the hyper-financialized U.S. economy that effectively make that kind of policy tool increasingly less relevant. And I'll throw a statistic out there for you for in terms of in support of that. If you look at the share of private non-financial sector credit that is on bank balance sheet in the U.S. versus off bank balance sheet, it's only 33% that's on bank balance sheet. The other 67% is being created by non-bank financial market participants. That 67% share is way higher than what you see in the Eurozone, what you see in China, what you see in Japan. And so in our opinion, when asset markets are in Goldilocks, which is what our global macro research is telling us, the credit machine here in the US is on, irrespective of what the level of rates are, because there's ways around that from a rehypothecation standpoint.
Yes. You talked about in your liquidity work, you talk about government source liquidity, which is both fiscal and monetary, and then also private sector liquidity. What is that private sector liquidity, and are we looking at the relative portions of it? When government's turned on, does it dwarf private sector? How do those work?
Yeah, 100%. So it's all about the speed. So and on a stock basis, private sector liquidity is higher. So in terms of if you break open our 42 macro global liquidity proxy into its components, the global central bank balance sheet. So this is the combined balance sheet of the major central banks in dollar terms. This is the combined money stock, broad money supply of each of those economies in dollar terms. And then this is the combined nominal sum of global FX reserves minus gold for each of those economies. So on a stock basis, money supply, the private sector liquidity is much higher than the combined shares of what we call public sector liquidity. However, at times, public sector liquidity can grow much faster or decline much faster than private sector liquidity. So it's very important as an investor to be be aware of this, because I'm not sure a lot of investors are aware that you need to track liquidity from its various component sources. But two, understand the leading indicators and the drivers of fluctuations in these particular statistics. That's something we do a lot of statistical work on here at 42 Macro, because it's not enough to just do what everyone else is doing on Twitter, which is telling you liquidity's up, therefore Bitcoin should be up, or liquidity's down, therefore the stock market should be down. That's not really an investment process, because it's not forward looking. And to be forward looking about these dynamics and ultimately make and save money with this information, you need to understand what drives liquidity. And so for things that have a leading edge in terms of projecting the private sector liquidity, it's things like the US dollar, it's things like bond market volatility, it's things like currency volatility, because those things, typically are, when they decline, those things are supportive for that, non-bank financial market liquidity creation function. And if you're trying to track public sector liquidity provision, if you want to front run that, you need to see things like inflation decline, you need to see things like unemployment rise, et cetera. So, we are constantly monitoring, trends and levels and momentum in those indicators. And relaying them back to, okay, what's leading, what's lagging, what's coincident, to understand, hey, we should be getting more or less liquidity from this particular feature, from that particular feature, and then from the other feature. So it's a complicated process at times, but the real summary and the neatness of the, how we think about liquidity in a holistic standpoint goes back to our model. We know that liquidity is trending higher, both domestically and globally. We understand the leading indicators for why liquidity is trending higher domestically and the leading indicators for why liquidity is trending higher globally. And therefore, we have some confidence that the current uptrend in liquidity in both of these features should be persistent for at least the next month or two. Now, again, we're not in the business of predicting the predictors. If these arrows, down arrows, inflect down tomorrow, we're going to ride with however they impact the composite signals. But obviously when we're having conversations with clients, we try to give them as much nuance as possible so they can structure their trades appropriately.
How about factors that people think impact markets that are not core to the economy, or this, for instance, geopolitical, or the changing dynamics of large portions of the rest of the global economy, China, Europe, emerging markets. Where do those factor in here, and how often are they the dog, and how often are they the tail?
Yeah, yeah, it's quite often they're the dog, not the tail. So again, I don't want to make a blanket statement like geopolitics doesn't matter, but I will say it doesn't matter if it does not impact one of these three things: growth.
I think, I mean, it really is. There's probably never been a better year than last year to know that geopolitics doesn't matter.
100%.
You
Yeah,
know?
no, 100%. Absolutely. No, it's when geopolitics has a direct influence on growth, inflation, and or policy, then it matters. However, until that point, the markets are very correct to ignore it. Because again, what we've known, I mean, you don't need me to get on here and tell you that growth, inflation, and policy are principal components of asset market returns. We all can agree on that, without having to go to the library and do a big statistical study. So what we're talking about in terms of geopolitics, kind of just putting a bow on this, it's just, for something like I'm using the Houthi rebels as an example. They're obviously causing ships to divert from the Red Sea, et cetera. It's potentially it is causing freight rates to rise. We're seeing a pretty significant rise on freight rates, but it has yet to really materially impact, crude oil prices. Crude oil is still neutral from the perspective of our volatility adjusted momentum signal. It has not really impacted global agricultural prices. Those are still neutral, but base metals prices are actually declining. So, we're not really seeing it impact the leading indicators of reported inflation in these particular economies, which is obviously a leading indicator for policy in certain respects. And so we're a long ways away from geopolitics mattering. And now it's not to say it won't ever matter, but it's only going to matter up until the point, or it's going to matter when it starts to actually impact one of these three kind of principal components.
Yeah, if the trade issue, and particularly with oil, continue to occur, you are going to see upward pressure on, the cost structure going through, and it will be modest inflation on goods, and you'll see modest inflation on energy. If it it is pretty surprising that you could shut down shipping in the Red Sea and not see oil prices go up a lot.
Yeah, no, I mean, my theory on this, right, is the market is calling OPEC's bluff, right? I mean, I'm not an energy analyst, so like I'm going to run out of things to say really quickly here, but it's very clear to me that the market is effectively saying, ha ha, you guys have all cut too much. You can't cut anymore. The supply's coming back. You can't keep cutting because you guys have, mouths to feed effectively. That's what the market to me is telling me.
Yeah, that's interesting. That makes a lot of sense.
So you mentioned, oh, sorry, I didn't,
No, go ahead.
No, USA, you mentioned China. So I was going to say, let's
Yep.
do a quick rundown of China and then we can kind of open it up. So, what we're trying to do in this table is, this is our kind of starting point for thinking about geographic dispersion, both in terms of the performance of the economies, but also in terms of performance of the asset markets. And so, just kind of going across the table, we see that Chinese growth is trending lower. It's below trend. That's the lagging indicator, GDP, is trending lower in terms of the leading indicator as well, the PMI. That's also below trend. The unemployment rate's trending higher, still below trend, so that's positive. Econ surprises have been persistently negative in China and getting worse. If you look at headline CPI is sipping over into inflation, it's trending lower in outright deflation and well below trend. Core CPI is trending lower, flirting with outright deflation and well below trend. And then inflation surprises were deeply negative in China, although getting slightly less negative at the margins. In terms of policy, Chinese liquidity proxies rising because we continue to see positive sort of liquidity dynamics from the both the public and private sector in China. It's not broken out in this particular chart. The policy rate's been trending sideways and it's below trend. The fiscal balance has been trending lower, although it's likely to trend higher based on the target that we got a couple of weeks ago from the Central Work Committee here. So it's heading towards 3%. So that's going to be moving in the wrong direction in terms of supporting asset markets there. And then the current account deficit or current account balance is trending lower, and at 1.8%, it's about as low as it's been, really since the modern China joined the WTO back in 2001. And then the real effective exchange rate, that number is trending lower and is well below trend. So it's ultimately telling you that there's obviously a capital outflow situation in China. And so that's kind of the starting point to think about China. Growth is trending lower, well below trend. Inflation is trending lower and effectively flirting with deflation. There is a muted policy response, but it's obviously not being overwhelming and forceful enough. And part of the reason we don't think it's overwhelming and forceful enough is that we, continue to see some real kind of headwinds on China in terms of the Chinese balance sheet dynamics that are preventing them from being forceful enough. This chart here shows private and financial sector credit to GDP ratios for the Chinese economy in red, for the Japanese economy here in black, the Eurozone economy, the UK economy, US economy in the blue, Indian economy, and Brazilian economy. And as you can see, at 228% of GDP, Chinese private non-financial sector debt is as high as it is in the world across all these major economies. And more importantly, the Chinese private sector, debt service ratio at 21% is much higher than all the major economies as well. So what that ultimately means is Beijing, obviously well aware of all these dynamics we just highlighted in terms of growth and inflation being structurally depressed, policy kind of not responding to that. I think the reason they're not responding is because they know they're pushing on a string from the perspective of these debt and credit dynamics. We keep saying that, hey, you can do as much countercyclical stimulus as you want in China, and yes, you will have a fleeting rebound in growth and a fleeting rebound in inflation, i.e. reflation is what that would be in economic terms, but it's going to be fleeting until you implement structural reforms. But the problem, China wants to implement structural reforms, because if they implement structural reforms, they're effectively going to have to, all that means is you're rearranging the deck chairs in the economy. And rearranging the deck chairs in the Chinese economy would effectively amount to, taking money out of state-owned enterprise coffers and taking money away from local governments and pushing into the household sector. And obviously, the party don't want to see that outcome just yet.
Yeah, I worked at CLSA for a while, and this was what all the headlines that talk about China as a rising power and a threat to us really didn't take into full account how much indebtedness that entire economy has, and there is a real problem when the growth is rolling over, because I think in the old days they were getting better growth unit out of every unit of stimulus than they are now, and
100%. Because
and
that means
unfortunately, I think we are too, but we have a totally different economic situation that at least
well,
is strong.
We don't forget we have a government down in DC that has been all in on socialization really since 2008, and that's kind of the key takeaways. I'm sure you're familiar with my former colleague Neil Howe, who's a mentor of mine, and his concept of the fourth turning, which is this generational cycle that kind of creates a lot of one of the many things it creates is big government, and sort of in response to some of these political dynamics, and so. In the context of all the socialization we've seen in our country, of course, we're doing better than China. Socialization works. That's what China proved in the previous 2 decades. It works, but there's a logical kind of end game for that. And I think I wouldn't necessarily say China has reached the end game because there's more things they can do, but they are a lot closer to the end game than they were 20 years ago.
Well, one of the things about your model is, the liquidity coming from the monetary and fiscal. Yeah, if you just turn it on, it's a real great drug for the markets and for the economy. But
really is.
at some point, it's not going to be such a good drug. There's just if it's always good, so far we're living as if we think it's always good no matter what.
100%. I completely agree with you, my friend. And that's what liquidity is, right? Liquidity kicks the can down the road. Think about it from the perspective of your credit card or your mortgage. More liquidity allows you to kick the can down the road. And so that's what markets like that. But, it's not our job to sit here and pontificate on what is good or better or bad for society.
Yeah.
I really don't care. My job is to help 42 macro clients make and save money on a consistent basis across market cycles. And, knock on wood, we've been doing a great job of that.
Well, I see that we're almost out of time. There was one topic that I don't know if you can do justice to that I loved about your work, and that was suddenly earlier this year, things changed a lot. And you said, that's because of productivity. It went from this to this.
My favorite chart right now, my friend. I'll walk you through it.
I remember the question was, so, what's productivity going to
Yeah,
do?
no,
I
I
think
think
your
it's
answer is worth you saying it, not me.
it's one of the most important charts in macro, my friend, because so
Yep.
going back to late October, early November, we pivoted to a tactical bullish stance in the markets out of our previous bearish regime because we understood that the positioning cycle dynamics were so extreme that you had to take the other side of the bearish bet, and that obviously proved out well for us because we ultimately transitioned to a positive, a risk on market regime in that process. And one of the things that caused us to make that initial determination in late October and early November was the bounce that we saw in productivity because we understood at the time that, hey, it's going to force people into the soft landing camp. And that probability in market implied terms was very low at the time. It's obviously quite high now. And so we saw this big bounce in productivity growth. What I'm showing in this top panel is the time series of year-over-year productivity growth. We show the 10-year moving average. We show the 30-year moving average and the 50-year moving average, and they're all coalesce around kind of 1.7%. So you think about U.S. economy, it's about a 1.7% productivity. It's about 20, 30 basis points of working age population growth. You clap your hands and you move on. That's kind of how we get to be a 2% economy. What the
Yeah, I
reason
like the way productivity is kind of a result of a whole lot of other factors, and it's not something that you can actually watch move and have
100%.
an exact answer on what's going on.
Yeah.
And so we can only keep our fingers crossed that this might look like the 1990s.
Yeah. Well, that's the key takeaway from this chart, right? And so you hit your nail on the head. You hit the nail on the head. Productivity and inflation economists have really no idea how to truly forecast it. We can build models that can tell you where it's likely to be, but it's not a real, genuine first principles type forecast because we
It
don't
almost kicks out of as a result of everything else. It's like
100%.
it's the
It's a
fudge
residual.
factor at the end. Oh, and
It's
look at what productivity is.
it's a residual. And so, but it's an important residual because ultimately it's the path to a soft landing. And so what I'm showing in this chart, the red dotted lines correspond to all the hard landings after a Fed policy rate tightening cycle. As you can see, there are mostly red dotted lines. There's two green dotted lines that correspond to the 1980s soft landing and then 1990s soft landing. And so how do you get a soft landing in the economy after the Fed is obviously, effectively tried to slow the economy into sometimes into a recession to defeat inflation? You need to have two things happen. You need to have the Fed acknowledge that it wants a soft landing by pivoting to rate cuts, which is exactly what the Fed has outlined it's going to do throughout 2024. And you probably need to have either some combination of above trend fiscal spending. That's what this chart down here in this panel here shows government purchases and investment on a year-over-year basis. The light blue dotted line just shows the long-term mean of that time series. Back in the mid 80s when we had the soft landing, we had the Fed cutting rates and we had way above trend fiscal spending, the growth rate of fiscal spending. Back in the mid 90s, we didn't have the fiscal spending support, but we had a massive productivity boom that, in our opinion, was in part driven by the capitalization associated with the internet. And so I'm not here to tell you that AI is going to be smaller or bigger than the internet, but I am here to tell you that it is a thing, and a lot of people think it's a thing. And if it happens to be anything like the internet, maybe even to a smaller degree, it's going to sustain a level of productivity that's probably at or slightly above trend, which is exactly how you can potentially get into a soft landing because we already have above trend government spending, and we know Fed is probably going to take interest rates lower over the kind of medium to long term.
Well, and especially if that chart of productivity in the 1990s was internet related, as you point out, it was the investment in the internet, not necessarily the result of
Use
the internet. And that's
100%.
what we're definitely seeing capital flowing into AI. So that might be part of the explanation there.
100%, my friend. So, like I said, we're not in the business of, predicting all these economic outcomes and all this stuff. It's our job to help investors position for the current market regime and position for the next market regime when it's time to position for that. That's if you keep doing that process daily, you don't need to know where productivity is going to be in 2026 or
That's right.
2027. We'll
Darius,
get
I'm
there
going to
when we
let you
get there.
go because it's your time to leave. I know
Oh,
you've got something to go to.
yes.
Thank you so much. I hope everybody enjoyed this. I certainly did. And great insights. Thank you,
Appreciate you,
Darius.
brother. I
Good
appreciate you,
luck
man.
to you. Look forward
Good
to
for having me.
continuing our conversation.
Likewise, brother. Be good.
Take care.